All right. Welcome, 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 everybody. Good evening. New primetime spot here. Great to see everybody. Happy Thursday. So great to see everybody come in. Let's get right to it. New 5 o'clock spot here. We're going over a very exciting series about the big, beautiful bill. And looks like we have some problem with our sound here. Let me just fix this. Let's see. Okay, you can't hear me. Sorry, I was just reading the chat here. So, okay, everybody can hear me. So, let's get right into it. Everybody can hear me correctly. Thanks so much, Kim, for just bringing me to that attention. We had some sound issues just going before this, but looks like we're on board now. So, today, like I said, we're going to go and talk about the big, beautiful bill. We're going to talk about just kind of like a recap we did last week. This is going to be a three-part series of what it means to you as a senior, as an American living under this new law, which is the law of the land passed by Congress and the Senate, signed by the president. Like we said last time, we are not politically affiliated. So our niche in here is just to bring you the straight facts so you can decide what to do with the bill, how it could benefit you, and kind of maneuver strategically here. We have nothing to sell you. Like we joked last time, we're not lobbyist funded. So pretty much here you're going to get the straight facts. You're going to get some actual insight that maybe major news outlets can't give you because they're always trying to peddle something. And then the second part, disclaimer here is we're not legal or tax advisors, so always take what we say with a grain of salt. You can look up things on the internet just to fact check what we're saying, and always bring this to your attention of your financial or tax advisor. This is a great precursor to those conversations. And we can have a recap for you too if you just want a copy of everything we talked about, the presentation notes. That's probably the best way just to kind of review everything. You can just write copy or just send us a direct message, send us an email. I think we're in talks with a lot of people via email, our community. So just send us an email and we can just give you the notes from this presentation. A great source too is to go to our website, over55nj.homes, where you can see all the 55 plus community active listings. You can always send us an email at over55nj@gmail.com. And we could always cater these searches to you. So we look forward to hearing from you. We have a saying, as you know, great real estate planning is done in advance. I'd say probably about the average person we speak to is about 1 to 2 years from moving, relocating, making this big decision. It's not so easy just to move around these days as it was. It's never really that easy, but it's it's never as easy as just moving around when you're younger. So we're here for you. We'll guide you every step of the way, and we can put a great plan together. Now, so just to go into a quick recap, so today's topic is going to be what is the catch with the $6,000 deduction. There's a catch in itself where the whole bill, people were talking about cutting taxes and eliminating taxes for Social Security, which didn't get through. So just like having this tax deduction is a tax and is a catch in itself because it's kind of just like a loss leader because the tax exempt status for Social Security did not go through. But we're going to talk into that. We're going to talk into what it means on different levels and just kind of so you can understand it a little better. But before that, let's just go into a quick recap of what we spoke about last week. Last week was a very exciting topic. We talked about the Trump accounts for newborns. So this is a great estate planning tool for your grandchildren, maybe someone else you care about. Every baby born between 2025 and 2028 is going to get started with what's called a Trump account, also known as a MAGA baby account. And the account's going to start with $1,000, and pretty much loved ones or anybody else can contribute $5,000 per year. There's some certain withdrawal rules are limited. It kind of works like a trust. And it's a great way just to estate planning. I told the story last webinar about my grandparents that took me to the bank and started me with a kid's savings account, which I always remember. And obviously, decades now, I'm still talking about it. So, great estate planning tool. It's a great thing where you can just kind of be involved and just set your children up with this and just give on a very easy basis. So, I kind of like it. Just to give an opinion, it's for everybody. It's not precluded or excluded. You're not precluded or excluded based on income, what state you're born in, etc. And it's kind of nice. It's a nice way. You're automatically set up with it. You don't have to spend money or the legal fees setting up a trust. And it's a great way just to kind of build long term wealth and something a baby 2020 born in 2025 and on will always remember and appreciate. Next topic. And next time we're going to talk into deeper estate planning vehicles too. We're going to go into some a little bit here and how it relates to the Social Security deduction. But that's what we talked about the first time. Then we briefly talked on the deduction. We're not going to steal our thunder here. We're just going to go into a little bit about that. And then we talked about the changes to Medicaid. Basically, the government's going to take a keener eye onto Medicaid. There's a lot of abusive fraud in many cases there. So you're going to be required to submit your paperwork every 6 months instead of 1 year. They're just going to start looking at this. The big thing when it comes to a real estate perspective is homes that have $1 million in equity, you may be excluded from Medicaid. So that's a great incentive just to start downsizing. Now, don't want to alarm anybody. That's going to start kicking into effect in 2028. So you have a few years, which is plenty enough time to put a plan together. But that's just something to be aware of because you definitely want to qualify for Medicaid. Healthcare can get very, very expensive. Just take it from me, that pays out of pocket. um, so we talked about that. We're going to talk into that, talk more about that into the summary. So let's talk about the Social Security and the catches there. So the first catch, obviously, is Social Security was not supposed to be taxed based on their talking points. They couldn't get that through. So this is kind of like a Band-Aid, if you will. The second catch is the deduction is only $3,000 if you're a single person. It's $6,000 for a married couple. So a little bit of a catch there. The third catch is it only applies on the federal level. So states with high taxes, we help a lot of New Yorkers come to New Jersey. We help New Jersey, and New Jersey, our taxes are not the lowest either. So those Social Security taxes will still be taxed on the state level as well. So the deduction itself only applies for the federal level. So $6,000, it's a nice deduction. A lot of people are used to kind of like the anchor tax where you just get the checks. That's another catch in itself where it's just a deduction. You're not going to get a rebate or anything like that. You're still going to pay taxes. You're still going to pay payroll taxes if you're still working. And there you have it. It's really not really what they're it's not really what was advertised, but it's still something nice and still something to take advantage of. What we will say too is when you're going over this with your CPA, always come prepared with kind of a memo. You'll be surprised how many times professionals will miss things based on the changing tax law, based on something that you may be aware of that they're not. You always want to be the professional when you come to the meeting. Great story. Ray Lewis, famous football player, said, "You really have a real meeting with someone when you come prepared to that meeting, and you probably know you could probably come and start talking about these better than your CPA or advisor can. And actually, they're the professionals; they're going to know more. But the point is if you come prepared with a memo, so nothing gets lost, you can hand someone a memo. It's a great basis of discussion. Amazon actually does this for their internal meetings when they're meeting to brainstorm a new product with everything. You come with a 6-page memo. You call it a 6-pager in the Amazon world. Everybody reads the memo, and then you can have a much more stronger discussion based on the foundation of everything. And it's pretty cool. If you want to look at the 6-page memo, there's examples online, beautifully written memos with FAQs at the end. These days, too, with the internet, with ChatGPT, other AI services, it's kind of like goes. It's kind of a good precursor to start working on these, and you'll be surprised what you can come up with. So another catch with it is, like a lot of things in the bill with the Social Security, after 2028, this tax write-off goes away. So it's it's only temporary, just like a lot of the things in the bill. So just something to be aware of. And 2028 is 3 years from now. That's much more further into the future. But long story short, and let's just we'll put a bow on this, is you just definitely want to be prepared with your CPA. You definitely want to be prepared and set money aside for your taxes, for your Social Security taxes. And then third is you definitely want to set money aside, and you have to be aware that you're still going to be taxed on the state level basis for your Social Security. Another thing is there's limits too. So I believe up to $75,000 or more. If you make $75K or more, you're still taxed on that. I have to take a look at that. I believe the limit for a married couple is 150,000. So there are income limits based on this tax write-off. But I would say if you're going to pick up one thing, just don't understand that you're still going to be paying Social Security taxes. It got very confusing, and the reason we wanted to make a separate video on this is a lot of people were asking and were confused on that. So definitely still plan to pay your Social Security taxes, and you definitely want to be planning just to pay your state taxes because this write-off does not apply for that. So you're paying the state taxes on your Social Security in full. So while it's definitely helpful, it's not an end or a be all to the taxes on Social Security that was advertised. Keep in mind, if you're single too, it's not a $6,000 tax write off, it's just a $3,000 tax write off. So it's still nice to have. You just take what you can get whenever. You got to take the layups when you can get them, as we say, but just something to be aware of going forward. And wanted to clear that up there because you're probably not going to get this in the major news outlets. So this directly applies to our audience. We just wanted to clear that up for you. Now, this is going to be a good transition into next topic is the exciting stuff, the estate planning aspects. The estate planning gift tax exemption did increase. We're going to talk about some vehicles next show, including the Trump account, 529 plans, which is another good one, and trust accounts that you can take advantage of to kind of like lower your estate tax burden and start to give to your loved ones. We just was working with a seller downsizing, looking into another facility, and she was saying like from the proceeds of my sale, can I give someone I know, a family member, $300,000? And a lot of people don't know this, that there's gift tax penalties per year. The gift tax is going to go up by 19,000, the exemption year over year. But there's tax penalties if you just give someone an amount over that, and the tax penalties are pretty significant. So we're going to we'll give some liquidation examples like that, but you'll be surprised how many people just write checks or just give the money and are not aware of this and put themselves at risk for these tax burdens. So we gave them a few ideas. This was for money for a down payment for a house. So we gave the ideas of giving the loan out yourself. We have had clients do that where you can give a loan to a family member with a very low interest rate, or you can even go in with them on the purchase and be a co-owner there. So a couple of good ideas there for that, where you can really, as my great grandmother used to say, give with warm hands and just like really set yourself up. Don't want to get too much into that. We're going to be we're going to talk about gift tax idea, estate planning ideas next show. We're going to go more into the MAGA baby accounts, the Trump accounts that you could set up as well and contribute to someone. So there's a lot of exciting stuff next episode. But this episode, just kind of like some housekeeping, just to talk about the Social Security tax exemption deduction, because there was a lot of questions on that. Now, let's go into some Q&A, and then we'll get everyone out of here for the evening. So great to see everybody. Thanks for joining. All right, so question one, is this a good time for seniors to consider converting traditional IRAs to Roth IRAs? Yes, it is. So the Roth conversion gives tax-free withdrawals. So you definitely want to convert those. You want to encourage your family members to contribute to those as soon as possible to let that grow tax-free. But this is it's a good idea to convert and to lower your taxable income, because the Social Security tax, you're going to be taxed fully on that. So this is a good prudent time to be doing this, especially the way the stock market's been going recently. Can I claim both this new $6,000 standard deduction boost and the $3,000 senior income deduction? So it's a good question. And this is where I kind of like the catch comes in. It's $3,000 per person. So a lot of times you see it advertised somewhere where it's $6,000. You get a $6,000 deduction. That is not the case. It's $3,000 per person and $6,000 per married couple. So If you're single, take 3,000. Just the easiest way to think about it is $3,000 per person, and then you definitely want to claim as much as you can. That's the name of the game. Question from Lala. Would it make sense to take money out of our 401k during the years of the $6,000 credit since we wouldn't have to pay tax on it? So this would be different. So this tax credit is for Social Security taxes. What is It could be for that. Yeah, I see what you're saying here. Um, I would, you know, it's a really great question. It really depends on your individual situation. I would let the money grow if you can and not touch it and just let it keep compounding. If you take money out, it is a good time to do it with a deduction, but you're going to be having this year over year over year. So if you have extra cash, I would use that first and think of like your money as kind of like a ladder. On the first rung of the ladder is your cash you want to use, and then you want to be dipping into your 401k and not just take that out, because if you take it out with the deductions, it's good thinking. I like the way you're thinking outside the box. But I would use your cash first, and I would let the money just keep compounding year over year. The average return, I assume you have like an index fund, but the average return on an S&P index fund is 7%. So you don't want to interrupt that compounding. You don't want to lower your compounding critical mass there. So I would definitely recommend using your cash if you can first before touching your 401k. It's not worth it for the deduction. I think there's a great quote, Warren Buffett, that when something's compounding, never interrupt it. So that's kind of like the rule of thumb there. All right, let's see this question. Will this deduction show up automatically on my tax return, or do I need to request it? I would think you would need to request it. We're getting like way ahead of ourselves before next April, that dreaded holiday, April 15th. But I would definitely have your CPA look everything over. You'll be surprised if you miss it, then you just miss it. Um, we we were doing our taxes one time and qualified for a backdoor Roth IRA. That's when your income limits exceed the limits. And our CPA at the time didn't realize it. So you definitely, this is a good story about just bringing things to your CPA's attention. I have another client of mine who's a real estate investor, does very well with it. And she's kind of looking to upgrade her CPA because she felt she was like kind of bringing a lot of things to their attention. So you definitely, this goes back to our discussion of just coming prepared with a memo. We can give you a copy of the presentation of kind of like a cheat sheet of things you can qualify for as someone 65 years or older or someone living in New Jersey. And it's a great basis of discussion for your CPA. And they'll probably have more things on the list to add to. And the idea is you just keep combining notes and then file the return that way. So it just comes from coming prepared. And unfortunately, you just have to kind of like watch the people you work with, but it doesn't have to be like a negative connotation like that. I would just collaborate with them, research, stay informed. This is a great resource for you. I'll be a great resource for you, but stay informed and collaborate. Everybody wins that way. Do both spouses in a married couple need to be over 65 to qualify for a full deduction? What a great question. So, how can I say this? It's mostly based on the individual. So, on an individual basis, but then you file your taxes jointly. This is a great question. We'll have to come back and research it for you. We'll do so next week. If we don't know the answer, we're not ashamed of just saying we're not sure on this, and we'll come back and research it for you. Having the answer like this sometimes is overrated, and if we don't know it, if we're not sure, it gives us a great opportunity to do the research. So, I originally thought when I was about to answer this that it's $3,000 per person, but then obviously a lot of people file taxes jointly. So this is just something that we'll have to research, and it's a really great question, and we'll find out the answer next week. See any other questions? I want to say too. I was talking to a customer who came through our website, and they were saying that your content's great, and we really appreciate the compliment. And they said we really want to hear from the members too. Any questions you have, if you have insights on the communities. You said like it would be really interesting to hearing from people that either live in the communities or that are going through the downsizing process. That's one of the reasons why we created this group is to be a forum because we were posting on social media. People were commenting like, "Oh, we love our 55 plus community. We don't love it." So we said, "Why don't we just create a forum just to hear from the public themselves and just answer questions and just have an open discussion." So if you have questions or if you have a shared experience, even if it's a negative experience in a certain community, please feel free to share it because that's really fascinating insights that you just can't get elsewhere. So like I said, feel free to share, and we love to hear from you. We love to hear your questions. We love to answer your questions. Any update on the stay in New Jersey tax break? That's a great question, Josephine. So we'll look up the latest information as well. I was under the impression it was going through with the budget, so we have to see where they're at on that. We anticipate it to pass, and we anticipate that to be a huge tax break for a lot of seniors. And also, that's going to further constrain the inventory for a lot of first time home buyers. But we'll get the latest information on you. But it's looking like a strong, strong chance it's going to pass. And I just want to get the final figures for you before I comment on that. Another example of finding out the answer. Let's see what else we got. Last question, the best for last. What happens if I turn 65 in the middle of the year? Do I still qualify? So that's a great question. Yeah, so you should. Um, I'd be confident in that answer. So if you're 65, you're going to be following taxes next year. You should qualify for it. Um, it's probably an easy thing to pass on. You file taxes the year prior. So let's say this year's 2025, you're going to file taxes next April. So you should qualify. There may be cutoffs here and there, but this tax is going until this tax deduction is going until 2028. So you if you don't get it the year next year, you get it the following year. But I would just go by the taxable year. That's an easy thing to just pass through. All right, fantastic. So great seeing everybody. New time spot this week. That's a wrap, and we're just so thankful for you to jump on. Go to our website at over55nj.homes. Let us know how you feel about this new time slot. We want to pick the best time for you guys when everybody can jump on. It's more fun when we have people coming on asking us questions. So definitely want to do it for you. If you can't make the show, we're happy to send you the recording as well. We understand things come up, so all good there. But just let us know. You can always reach out to us, direct message us anytime. Email us at over55nj@gmail.com. And great resource that we always recommend is over55nj.homes, where you can start setting up searches. You can set up like a weekly digest. You can cap your HOA fees. Even go specifically by communities. We have a bunch of communities on the website where you can just set it up and do a very focused search and just kind of customize it based on your needs. So thanks so much for watching. We'll see you next time around. Hope everyone has a great weekend, and we'll see you soon. We'll see you on the next one.